the vehicle that you know. That is going to happen. I think now it's 2021. That's going to happen pretty soon, because in countries like China, in terms of autonomous driving, they have already not throughout the whole country, but in selected smart cities, they have reached a level of level 4. The highest level where it's full autonomous driving is level 5. So level 4 has been reached, and what the governments, what the car makers are waiting for is the rollout of 5G. Because without 5G, you cannot really have truly autonomous driving. It's with autonomous driving, you need to have very, very low latency. You need to have very high speed, because the car, that vehicle that you're in, is going to be connected not just to one other device, but it's going to be connected to all the other cars on the road, the traffic lights, and so on and so forth. So you find that only 5G would be able to give that technical capability of an autonomous plus electric vehicle. And I think one simple answer to this question is, even Apple, the Apple phone and so on, is already thinking about becoming a competitor to Tesla. So I think that's the best confirmation that Tesla will be a digital. It cannot be just digital, it's a digital plus business. And all car makers, will they be able to compete well with Tesla? It's not just Tesla, there's so many EV car makers. Now, when I say EV, I'm also assuming autonomous vehicles will come in pretty soon after that. So even Xiaomi also is going to EV. And a lot of the traditional car makers have already announced that they will stop making the internal combustion engine cars sometime in the next 5 to 10 years. So the old car makers, if they just stick to internal combustion engine, they will not survive. They will not be around anymore. Not just from Tesla and NIO and XPeng and all those BYD and all those, but also from government regulations, where most countries are going to be carbon neutral pretty soon. So with the targets of achieving carbon neutral, internal combustion, not just cars, internal combustion, buses, motorcycles will be coming, will get less and less. Does it pay to invest in deep value company? Why does a stock go into deep value, and what circumstances will play out from existing situation? Every company would have different reasons why the company will go into deep value, and what would the circumstances that will pull it out. Again, it will differ from company to company. But I think if you look at, say, the company like BlackBerry, it used to be the technology company, the smartphone that set global standards. Even former President Obama was swearing by BlackBerry. And yet, in a space of a couple of years, BlackBerry has got to transform. So the old BlackBerry device, the old BlackBerry phones are gone, and they're trying to bring in new businesses and new technology. Will this succeed? So far, not yet. So far, the company is still, at least it has gone beyond the stage of immediate liquidation, immediate bankruptcy. At least they are in the stage of fighting chance. Will they be able to get out of it? So far, they have not succeeded, and I'm not sure. I'm not sure whether they will succeed or not. But to answer this question, does it pay to invest in a deep value company? You really have to look at the factors which are specific to the company and the industry. There's no general yes or no answer to this. okay, this person Mingling wants to be a good fund manager like me. Well, I'm a fund manager. Whether I'm a good fund manager, I leave it to my customers. So he or she is an undergraduate student in finance. What kind of skill sets would I want to learn about new value investing? What is required to be a good research analyst and fund manager? Career prospects of an analyst at Capital Dynamics. Thank you very much for the kind words. I think the skill set, whether it's new value investing or old value investing or non-value investing, they are more or less the same. You really need, whoever wants to be a good research analyst or fund manager, you got to be really be prepared for a lot of hard work. It's not just sitting in front of the monitor and typing in some searches and then getting your answers. If it's as simple as that, I think a lot of us would have been good analysts, good fund managers. Or because it's so easy, none of us would have been good fund managers, none of us would have been good analysts. So you need to be able to be the type of person who is able to dig. You must be a curious person. You must be a person who keep asking, why this, why that, how this, how that, when. So a curious person is important. And then you must be able to dig deeply. You must be able to dig in areas where other analysts or other investors don't bother to look at. So for example, this morning's submission, why I zoom in on when Jollibee did their presentation, where the team presenting Jollibee did their presentation, inside the appendix, they put in the NYU. NYU is the New York University Stern Business School. They have a synthetic spread. So my curiosity was, why did they go and choose this particular variable? So have curiosity, be able to ask and dig into areas where people don't bother, people assume, or people are complacent and don't bother to ask. And you'll be surprised, working hard. Working hard means long hours. To be a good fund manager, to be a good analyst. I mean, if you are a fund manager, you got 100 million ringgit to invest for your customers, right? You cannot just be familiar with 20, 30 stocks, because at any point in time, you might not be able to invest in all the 20, 30 stocks, or at any point in time, you might be able to invest in only 2 stocks. So then what happens to the rest of the portfolio? So if you have 100 million, you might have to be familiar. You have to be familiar with at least at a very critical level, at a very deep level, at least of about 200 to 300 stocks. And beyond that, you must be somewhat familiar with another at least 200 to 300 stocks. So in all, you got to be following, you got to be familiar with at least 400 to 500 stocks at different levels of familiarity. Now, to do that, it cannot be done in a 9 to 5 kind of schedule. You got to be prepared to do it like 12, 13, 14 hours, almost non-stop. And research analysis cannot be a 9 to 5 job. It doesn't stop just because the clock ticks at 5. Something happens. COVID-19 suddenly escalates all over again. You know, here you have the trend going down, and then suddenly there's a new cluster, and before you know it, tomorrow the government announced that there are 5,000 new cases, and then the market tumble. So you're always thinking about the businesses, you're always thinking about the companies, you're always alert to new developments, new trends, and you're always trying to connect the dots. Paying attention to new trends, new developments, that's the easy part. Being able to connect the dots, that is where you need to be analytical, you need to be well informed, you need to be curious. Like for example, especially in the investment environment of the last few years, where a lot of unusual things are happening, you know, where in the last 1 or 2 days, you have the huge container ships stuck in the Suez Canal. It's never happened in global history before. And this is Suez Canal. Suez Canal is as busy as the Straits of Malacca. So you have a huge tanker that's creating a traffic jam, whereby ships from Europe cannot come to Asia, ships from Asia cannot go to Europe. And if you want to take the alternate route, which is down the Cape of Cape of Good Horns in Africa, you incur at least another 14 days. So what would that do to supply chain? So that's just to give you an example of why you got to be able to think and connect the dots very quickly, right? And of course, you got to have basic financial skills. Accounting is a language of business, so you must understand. If you want to be in that kind of area, you must understand the language, which is accounting. You must be able to look at financial statements, not just look at them, but you must be able to adjust them. Because if the job is so simple as just looking at the accounting profit, then many of us could have been good analysts. But a lot of accounting profit are not what they are. As like I gave the example this morning, Razer, which is a gaming company, $1 billion over in US dollar sales and hardly any earnings. So what are you going to do? So you must be able to look beyond the figures presented in the financial statements. The career prospect of an analyst in capital dynamics, well, they're always excellent, provided you have the right skills, you have the right personality, and you are deeply committed. We love to have people like that. And if you are good and you're able to contribute, you'll find that one day you will be the CEO of Capital Dynamics. Traditional valuation methods still applicable for traditional industries, for example, banks? Yes and no. Banks are, okay, there are banks in Malaysia and there are banks outside Malaysia. Banks in Malaysia are a bit, maybe I can ask Dato' Nasser on this. Banks in Malaysia are a bit behind time, a bit dinosaur. If you look at banks outside Malaysia, they are already way ahead in terms of digital transformation and so on. Take the case of Bank Rakyat Indonesia. I mean, Indonesia is supposed to be behind Malaysia, but if you look at the extent Bank Rakyat is involved in digital payment, digital transformation, it's actually quite amazing. So to come back to your question, traditional valuation method would be when you look at, say, for example, price to book value and all that, it doesn't really, it's not that accurate anymore, because banks like advertising companies, like travel agents, like all other traditional businesses will be hit by this new technology that's coming in. It's not just the processes that is being digitalized and being changed by technology, it's also the possibility of cryptocurrency. I mean, Tesla announced that they invested in Bitcoin, and they just announced that if you want to buy a Tesla, you can pay them in Bitcoin. That is a game changer. The one thing that can block cryptocurrency from becoming official would be where the government makes it illegal. But I think the trend is pretty powerful. It will be quite difficult. So to come back to your question, traditional valuation method has to be changed for, even though the industries are traditional like banks. Question 5 is more or less the same. Like for example, you talk about industries which are land-based, say property industry or plantation. Sometimes the competition, sometimes the disruption doesn't come directly. It could be indirect. All right. For example, say palm oil plantation, right? Now, because they can use the drones, the plantation companies haven't really used it to a large extent yet, but they can use drones to monitor or to do harvesting, not harvesting, to do the application of the pesticides and so on and so forth. So there is this disruption coming from technological changes which are being applied to so-called industries which are land-based, like say plantation. Now, in the case of hotels and properties, right? Now, in the case of hotels, you already know the biggest disruption is Airbnb. The traditional type is where you got to build a hotel and so on and so forth, invest so much and so on. But Airbnb, I mean, the guy is great. He, in the case of the pandemic, Shangri-La hotels, Hilton, Marriott, all suffered like mad. But Airbnb doesn't have a single asset to be worried about. There's no single hotel that they have to close because all their accommodations are all third parties. And these are all small places where you don't have to worry about crowds and all that. So when you have, say, hotels, which is accommodation, which is supposed to be land-based, but being threatened by a company like Airbnb. So how are you going to value hotels and how are you going to value Airbnb? The hotels, okay, Airbnb is not as major a competitor as Amazon.com or Alibaba yet, but it will. It just got recently listed. It will, in the next 5-10 years, it will be a very serious threat because the pandemic did not hit them as badly as the traditional land-based hotels or accommodation businesses. So yes, you have to be prepared to use different valuation models for even industries that are land-based. Because like it or not, there'll be more imitators of Airbnb. Like it or not, these are the companies that will compete with your Hiltons and your Marriotts and so on. So is new value investing model applied to only certain industries? No, I've just explained, right? And will I invest in Pfizer-like companies? Pfizer-like companies, I'm not sure what this means. Because when you say Pfizer-like, are you talking about the fact that it's a healthcare or whether the business model of Pfizer? Now, generally, I'm a bit skeptical, particularly if the healthcare company is a dentist or a traditional hospitals, because I'm a bit old-fashioned in the sense I don't believe that the hospitals and all those type of businesses should be managed on a profit-making basis, because you get a situation where you know, you go to wherever Sunway, Subang, or Glenmary, the first question they ask you is, are you coming in as a private patient or insured patient? If you're a private patient, you know, you're treated differently. If you're insured patient, then they ask you whether you want to do blood test, X-ray, MRI. So they'll load up your billings so that they can earn the revenue. So when it comes to healthcare in terms of ESG, you find that I am not particularly keen with this type of healthcare company because of ethical reasons. So if you're talking about biotechnology, that's a bit different. Like say Illumina, where they do DNA sequencing and all those things, that is something that we look at. In fact, I've looked at some of these companies for quite some time, but haven't been able to invest in them. Thanks. Bamboo Value Investing got a newsletter, got any discount? Our newsletter is only 99 ringgit per year. We cannot give you any more discount because the delivery cost of the newsletter a year costs more than 99 ringgit. So every copy we send to you, we are already losing money like crazy. So if we give you any more discount, then we might as well close shop. But no more discount. In fact, we're thinking of raising the price. Bamboo Value Investing is very similar to new value investing in the sense that if you have $1 of earnings that is generated in America and $1 of earnings that's generated in Indonesia, are you going to value them on the same basis or they have to be valued differently? In other words, whether it's bamboo investing or new value investing, you got to look at the context of your investment. Thanks. Can I conclude that most tech companies are merely enabling middlemen who utilize low value platforms Okay, tech companies is a the term is very wide. Is Tesla a technology company? Yes, I guess so. Because if you look at Tesla, there's so few parts, there's so few moving parts inside Tesla. There's no crankshaft, there's no camshaft, nothing of those. There's no the traditional type of components inside it. A lot of it is software. I mean, of course, you have the tires, the steering wheel, right? But the rest of it is basically software. It is actually a software on four wheels. So it is a technology company, but it is not a middleman. It is not a platform. So tech companies, I guess what you're maybe referring to is maybe the Amazon.com type or the Alibaba type, where they have a platform and then they are just enabling different people to get connected. The situation now is that these so-called platform companies have reached a stage where it is almost impossible for them to be competed away, unless the US government, the European governments, or like the Chinese government come in and make sure that competition is more free. Because these platforms like the typical ones, they've got to a stage where they are so powerful financially. In terms of technology, they are so powerful. It's hard for them. It's hard for the traditional type of businesses to go and compete with them. So if you're talking about technology companies in this type of IT platform, they have grown to be a lot more than that. I mean, they're smart. In the case of Amazon and Alibaba, they've gone into not just the traditional online business, they've gone into also offline so that they can connect offline and online businesses. Technology stocks in US corrected quite a lot recently, mainly due to bond yield rising. What's your view on technology stocks there and whether the correction trend is still short-lived? First thing is the bond yield, most likely particularly the 10-year bond yield, most likely will be rising. It's about 1.6, 1.7 now. It will probably gradually go up to 1.8, 1.9, 2%. I wouldn't be surprised. And as it creeps up along the way, I think the tech stocks would be sort of constrained by this rising bond yield. I think you got to distinguish between technology stock, because again, the term is very wide. A semiconductor stock, is it a technology stock? Yes. A stock like a gaming stock, is it a technology stock? Yes. But a semiconductor stock like Intel and AMD and so on and so forth, their valuation is actually relatively low compared with, say, like some of the tech stocks that I look at. One is called Covo, which is leveraging on the 5G technology. Another one called Form Factor, which is producing probe cards, which probes the semiconductor wafers and all that, right? They are also selling on the relatively low PE. So this type of companies probably, because the prospects of growth are still there, and because the current valuation is not excessive, so you find that the correction may be less severe than a lot of other companies where the valuation is 100 times and the earnings are not there yet. So those are what I call in my presentation the long duration equity, where it's like a long-term bond, where you might see the earnings only in 10 years from now. So if it's a long-term bond, if your bond is only 1 year and the interest rate goes up from 1 to 2%, compared with a bond that is 10 years, even though the interest rate goes up by the same amount, the long-term bond would see a bigger fall in the bond price than a short-term. So the same thing, because you got to discount a lot over a longer period. So the same thing for technology stocks, which are on high PEs and you don't see any earnings coming in until maybe 5-10 years from now. Those are the ones that most likely will be hit harder. So let me say this again. Tech is a very, very wide sector. It covers the traditional hard end type, the allied materials, to your Intel, to all the way to the soft. And the soft, even in the soft technology now, there's so many. Microsoft is considered an old technology company already, because now you have things like, of course, cloud computing, and not just cloud computing, you have edge computing, which is also relatively new. Can new value investing be applied to Malaysia stocks? Yes, definitely. Notice that ICAP, the closed-end fund, is trading at a huge discount. Yes, I totally agree with you. That is a question that you might want to raise it with City of London, because they are the one who has damaged the share price and manipulated the discount of the share price to the net asset value. So there seems to be an attempt to keep the stock price at 2 ringgit to 203 against its net asset value. Is there a way to find out who is doing this? I love this question because I'm also very, very frustrated to find out why is there somebody trying to keep the price at this range. And we hope that truth will eventually prevail. And I am very frustrated and angry with the way City of London, when they actually bought more than 20% of the shares and breached the Securities Commission's guidelines. So I really hope we can do something about this. Is new value investing a methodology that can apply to stocks in KLSE? Yes, anywhere in the world. Is there a guide that retail investors can apply? At the moment, like I said, we are the only one talking about it. You do a Google search, you cannot find it. Either come attend to listen to our talks or subscribe to iCapital 99 ringgit, where sometimes we write about new value investing. But just to give an example, earlier, which I shared with you all, Warren Buffett sold all his airline stocks. We bought AirAsia in April and May. When we bought AirAsia, we have clients that have been with us for 20 odd years, since 1998, 1999. When we bought, and they have never call us at all whenever we buy or sell any stock. When we bought AirAsia, immediately they call up. It's like, Mr. Tan, are you going crazy? Are you going mad? So my answer is very simple, like you all said, like what Warren Buffett says, right? Which I think he has forgotten. When people are fearful, be greedy. When people are greedy, be fearful. So here you have a situation where people are so fearful that the minute I bought AirAsia, they call me up. We wanted to buy more, but unfortunately, our customers were so uncomfortable that if I buy more AirAsia, I will lose customers. But is there new value investing in it? Definitely, because as I explained to some of them, AirAsia has been listed for many years. And in the first analyst briefing that Tony Fernandez presented, I was there. I was been following AirAsia for a long time, but we haven't bought AirAsia. This time we are buying AirAsia in quite a big amount. And we are buying AirAsia not, I told Tony Fernandez, I'm not buying your AirAsia because of your airline business. I'm buying AirAsia because you are going to be a digital company. And if I'm right, I guess AirAsia should be a lot higher than what it is now. So in this case, if you look at AirAsia just as a pure airline business, yes, then you use the traditional metrics. But because they are transforming, I mean, the company, AirAsia said it many times, they are transforming. And when they do the transformation and when they succeed, then I guess AirAsia will be looked at differently. And you have to use new valuation methods, different valuation methods to value AirAsia. The ban, effect of the ban by the US government on China-based company, blah, blah, blah. It wouldn't affect the business. It's just the listing. Like, for example, Alibaba or Baidu or whoever it is, you just move your listing back into Hong Kong or Shanghai because these companies don't have businesses in US. So in terms of business itself, there's no impact. Will the trade war between US and China get worse? As an investor in US and China market, what are the risks that we have to pay attention to? It's not just a trade war, it's actually a war between US and China. You have to take out the word trade because US under Trump was a bit, not a bit, Trump was very crude. Trump doesn't have manners. Trump will just trumpet his own views and then bash you. Biden is a bit more, maybe because he's older, maybe it's because he's been in the government for 30, 40 years, so a bit more polite, a bit more civilized, but he's as bad as Trump when it comes to bashing China. So the war that the US has launched against China is not on the trade level, like what Biden says, you know. China has got an objective. China has got an objective of wanting to be the largest economy, the most powerful country in the world, blah, blah, blah. And you know what he said, Biden? Biden says that as long as he's still alive, China will never succeed. So it's not about trade. It's about making sure that Xinjiang will be separated from China, Taiwan will be totally separated from China, Hong Kong will be separated from China, is to basically break up China. I've said this many years ago. I think I said this 5-6 years ago that US is really on a war path with China. And it's just that a lot of Asians, a lot of Chinese don't seem to realize how can a civilized democratic country like America be such an evil country. It is an evil country. What are the risks that we have to pay attention to? A lot of risks. It can affect currencies. It can affect the listing status. It can affect your businesses. So if you don't want those kind of risks, then find companies where they do businesses only within their own country, within China itself or within US itself. There are a lot of companies that are like that. The most reliable valuation strategy to be used in your new value investing concept. I think first you got to understand this value investing version 3. Because in version 1, version 2, Benjamin Graham will tell you, I don't know what is happening to the economy. I wouldn't know. But Warren Buffett will tell you the same thing. Warren Buffett will say that if the chairman of Federal Reserve were to come and tell him that he's going to raise interest rate, Warren Buffett wouldn't listen to him. So this version 1, version 2 ignore macro factors. When I say macro factors, I don't mean just macroeconomic. It could be climate change. It could be the pandemic. It could be something like, for example, the ship being stuck in the Suez Canal. So the new value investing is context-based. It's based on the context. What is the context that you're investing in? And the context will vary from situation to situation, condition to condition. Question 14 is quite similar. Can we use the price to sales valuation method? Yes, of course. It has to be relevant. It has to be appropriate. For example, if the company doesn't have any earnings, but you can see, like I shared in this morning presentation, Amazon.com in the first 8 years, where the sales grew from 16 million US dollars to $5 billion, and they still didn't have a single cent of earnings. So how are you going to use the usual valuation, right? You got to look at sales, because if they're able to grow the sales, you're confident they're able to, one day they'll get the earnings. So sometimes price to sales will be useful, but you have to see the circumstances and the situation. Fast growing stocks comes with high multiple. Can we invest business with such a high multiple? I think the Jollibee team answered me very well. You have to also pay a reasonable price for growth. Just because it's got a high multiple, it's high growth, doesn't mean that you overpay. You have to pay a reasonable price. So what is the reasonable price? You have to know the business, you have to know the business model, right? Like the famous example that I given is Tesla or Amazon.com, right? Where sometimes they don't even have a multiple because it's negative. So how can you invest in such businesses? So you have to see how familiar you are with the industry, the businesses that they are creating. Next. How much margin of safety? It depends on the stock. If it is something that, like in the case of Tesla, I mean, like I said, I've been very unlucky when it comes to Tesla because I've been following them for so many years. I think I'm the only Malaysian fund manager who has visited their factory in California. And I've also seen NIO in Shanghai, tested NIO electric cars there. And the last time I saw Tesla was in November 2019. And before I could even finish my evaluation, they came out, 1 week later, they came out with a very positive news. Okay, before I could even absorb that positive news, the second positive news came out and the share price went up again. And the third week, this is how lucky I am. The third week, the third positive news on Tesla came out. So in that 3 to 4 weeks, the price of Tesla doubled. How much margin of safety do you use? That is a very tough question because if I had known all those positive news are going to come up by the end of November, I would have bought all the Tesla that I wanted. But every time you got to keep on incorporating new developments because new developments, one of the positive news was their China plant started operating. China's plant started producing. The other positive news was their quarterly earnings, the quarterly results were much better than expected. So then it keeps on affecting your valuation. And because valuation is a moving target, it's not a fixed number that, oh, it stays at $50 throughout the whole year. No, it keeps on changing, it keeps on moving. So the margin of safety will be how comfortable, how familiar are you with the business, not with the stock, with the business of the company. Are all your funds managed based on new value investing? Yes, since the last 1 to 2 years. Before that, in 2017, I'm still as old-fashioned as Buffett and so on, which is why we had high cash level and our performance was losing behind the S&P and all that. But as I explained this morning, I've done a lot of research. I've done a lot of soul searching and looking at different periods of time, different markets in the world. And that's why I came to this conclusion that there has to be value investing version 3. And which is why during the pandemic, we didn't sell our shares. We had only about 3 to 5% cash, even though markets were all tumbling all over the world. What are our thoughts on tech and software stocks trading at multiples of 20 times sales? Again, it cannot be answered in isolation. Give you an example, Adobe, right? I mean, if this is a physical meeting, I will have asked you to answer my question. What is Adobe to you? Is Adobe just that Adobe program? No, Adobe is, I cannot remember the multiple. Adobe is trading at the multiples of I don't know how many hundreds of times. But the current CEO transformed Adobe from just your Adobe, the PDF that you know, into an incredible multimedia company. The transformation was unbelievable. So that's why I went to see them because I just couldn't believe the transformation. So when you have a company like Adobe, which used to be like just PDF, of course, if it's just PDF, then you just give them a certain valuation. But this is more than that, a lot more than just PDF. And they've gone into areas that I never imagined they could have. So how do you value this? Then you have to understand their business strategy, their technology strategy. What is it that they want to be and whether they will succeed. Okay, if you understand their strategy and you think that they will succeed, then of course you do a certain valuation on that. So company specific, no general answer to this. You can look at Microsoft. Microsoft has also transformed. Okay, same question. PE no longer, it's not just price earnings anymore because sometimes there are no earnings, right? Or how do you value a company that is able to double their earnings in 3 years, 4 years, 5 years? Compared with a company that doubled their earnings in 20 years. So what PE multiple are you going to give them? So again, like what Munger says, you have to value the stock, you have to understand the business thoroughly. If company meets all the criteria for new balancing concept and selected for investment, how do you anticipate and handle government policies like that by the Chinese government now? Government policies all over the world change. It's not just the Chinese government. In fact, the Chinese government is famous for stable policies where policies don't get flip-flop like in Malaysia. So if you look at like US, government policies change every time there's a new president. In the past, Trump says, I don't want to be part of WHO, I don't want to be part of WTO, I don't want to be part of UN, I don't want to be part of the Trans-Pacific Partnership. Then Biden comes in and says, no, I want to be part of the Paris Accord. I want to do deal with Iran. So how do you handle a country like Australia or like US or like UK, where the government policies change every few years? Whereas in the case of China, the government policies are actually very predictable, very stable. How does safe value investing apply to glove counters where investors run for their lives when price crash more than 50%, even though it's great value in terms of PE revenue and profit growth? What are the dynamics for glove counters to nosedive to a level where no life is survived? Okay, Jackson Lee, if you had subscribed to our iCapital, you would have either not got into glove stocks or you have got out Hatalega and Top Glove at very good prices because we wrote a very simple analysis. Glove stock is a commodity stock. It's a commodity stock like rubber or palm oil or copper, just like any other commodity. And if it's a commodity business, this is a commodity stock, you can only make money when there's a shortage. When there's no shortage, the supply exceeds demand, the average selling price will be down, the profit margin will be down, even though they may build another 100 glove factories. So understand the business model, and it is a commodity business. And like I said, commodity businesses will prosper only when there are shortages. Now, then you have to ask yourself, how long will the shortages apply? This glove bubble that we see now is not the first time. We had a glove stock bubble in 1980s, in the mid 1980s. That time, there was no Top Glove and all that. But the same thing happened. That time was AIDS. That time was the HIV scare where people were so scared. You know, they thought that HIV could spread by just kissing or touching or whatever it is. And glove was in hot demand. Exactly like what you see now. And HIV up to now, just for as an aside, HIV up to now, there's no vaccine for it. People have forgotten. So what happened? Everybody jumped into the glove industry. People that don't even know what glove is all about set up glove factories everywhere. So the same thing is happening now. So that's what we wrote in iCapital last year, that you will see the demand because you can see the COVID-19 cases, but you cannot see the supply, where it's coming from. And the supply is not just coming from Marsing. You know, Marsing is a property company going to glove, or another company in Penang, which has nothing to do with glove. It's not just coming from there, it's coming from the Thai competitors, coming from the Indonesian competitors, coming from the Vietnamese competitors. And believe it or not, Taiwanese competitors are going to glove industry. So you do not know the supply. If you do not know the supply, then how can you know whether the shortage is still there or not, or whether there's a glut? If there's a glut, what is going to happen? So value investing can apply, but in this case, you got to be sure you apply it to the correct business model. If you apply it assuming that the glove demand, the glove sales and earnings are going to grow like 20%, 15% for the next 10 years, then your business model is wrong. Okay, I think that's the last of the question. So I pass back to yeah.
Hi everyone, thank you Tingbu for this Q&A session. So the event has finally come to an end. A very big thank you to everyone for joining the 2020-2021 Budding Value Investor Award. To all the finalists, thank you for your hard work on your research, and to the winners, once again, congratulations, job well done. So last but not least, we will be emailing all of the audiences a feedback form. So we would really appreciate a feedback from all of you. And in the meantime, please take care. Thank you. Bye.